So are the banks going to do the Fed's job from here by choking off access to credit?
No. The banking industry is in excellent shape. It has lots of capital. It has sufficient liquidity. We have here a situation where a single bank, who is very unusual, there's not another bank like it in the United States or probably ever anywhere, who failed to risk manage their company, and it set off a run, a bank run, a typical bank run. And what happens in a bank run is that no one is looking at the qualities of their institution. They're taking their money out and putting it into another institution to spread the risk. And then they'll ask questions afterwards. And it's an unusual situation, but when the industry is strong as it is today, it will settle down. And there's no relationship between what's happening today than the crisis we had in 2008.
Well, I was really just asking about if the banks are going to do the Fed's job then by slowing down access to credit, which some people are saying is a reason for the Fed to pause now. So are you saying that the Fed perhaps shouldn't pause to keep inflation under control?
No, I think the Fed's going to do 25 basis points. They probably were going to do 50. They won't do that now. And they will do 25 probably, and then another 25, because the Fed also realizes this is just a liquidity issue, and you don't slow down liquidity by reducing loans. You do the opposite, as a matter of fact. You keep the economy going well and strong, and it can. Now, again, the Fed's job is to make sure that there is liquidity in the market. If the Fed is worried about a bank, it may want to stop that bank and stop it from lending money. They're not worried about the financial institutions in this country because they're very strong. They want to make sure that they have the money available to them so they can continue to make loans and serve their customers. And that's probably the most important reason why we have a Federal Reserve, is to provide liquidity to safe banks when the markets aren't operating appropriately.
Yeah, I want to go back to the point you just made that essentially, SVB was kind of a one-off. I mean, we did see 3 U.S. banks, regional banks, fail in the past week. And I think the question's been raised on whether the fact that Wells Fargo was essentially in the doghouse with regulators and wasn't allowed to essentially grow assets for a time, whether that enabled SVB and some of these other West Coast banks that have been in focus in recent days to grow unusually fast in terms of deposits and assets. And that essentially led to their woes. I want to get your thoughts on that.
No, not at all. Again, I don't think any other large bank would have wanted deposits from a very narrow, volatile industry like the venture capital industry to be anywhere close to 90% of their company. In fact, they probably would have been, or at least if I was running a company, I wouldn't want more than 5%. So this is a very unusual situation. So it kind of makes your point, is that there are plenty of banks in the Bay Area that could have been doing what SVB did, but elected not to do it because it's very risky to have a bank just in this very narrow area with very narrow customers and customers that have a very volatile business model.